Welcome to the Deep Dive. Today, we're zeroing in on a really fascinating moment in finance history, looking at Morgan Stanley's strategy back in April 2015. What's interesting here is this wasn't just a look back at 2014. They actually laid out their explicit plan for the next 5 years.
Exactly. And you have to remember the context. This letter came after 5 pretty intense years for that management team. They'd been working flat out since the financial crisis to reshape the firm, basically getting it aligned with, well, a whole new world of operations and regulation.
A new world is right. So this document, it sort of marks a turning point.
Absolutely. It signals a shift, from just getting through the crisis, the transformation phase, to actually executing a forward-looking strategy. And they built it on 3 core pillars. A real focus on clients, on culture, and of course on talent.
And the aim.
Consistent earnings, higher shareholder returns. The plan was to achieve this through a more balanced, diversified business model across their main divisions.
Right. That's investment banking and sales and trading, wealth management and investment management.
Precisely, a balanced approach.
So for this deep dive, we're going to unpack 2 really key areas that jumped out from that letter. First, the, surprisingly aggressive goals for wealth management. And second, the huge reshaping they undertook in their fixed income business, FICC.
Yeah, 2 massive strategic pillars right there. Wealth management becoming the engine, and FICC needing some serious re-engineering.
Okay, let's kick off with wealth management. They clearly flagged this as the main driver for higher returns, didn't they?
Oh, absolutely. It was positioned as the sort of stable core. They'd already made good progress, mind you. In 2014, the full-year profit margin in wealth management hit 20%. That was up from 18% the year before.
Okay, respectable growth.
But here's the kicker. The letter laid out a target for further growth in 2015. They were aiming for a profit margin between 22 and 25% by the end of that year.
Wow, 22 to 25%. That feels like a big jump in just 1 year. Was that, achievable?
It was certainly ambitious, no doubt, but they felt confident. Remember, they had a massive base, $2 trillion in client assets back in 2014.
Right, $2 trillion. That's a solid foundation.
And crucially, they were riding the wave, the trend towards fee-based managed accounts.
Okay. Moving away from transaction commissions.
Exactly. When your revenue comes from fees on assets under management, it's just much more stable, much more predictable. It's less tied to, the daily ups and downs of the market.
And easier to scale efficiently, I suppose.
Precisely. That stability was key to their confidence in hitting those higher margin targets.
And what about the clients themselves? I noticed they specifically mentioned focusing their resources.
Yes, that's a really important strategic point. They weren't trying to be everything to everyone. They explicitly targeted high net worth and ultra high net worth clients, HNW and UHNW.
So focusing on the top end.
Right, which plays directly to Morgan Stanley's traditional strengths. These clients need complex advice, bespoke solutions, things where Morgan Stanley could really add value, and importantly, where the fee potential is highest.
So it's a strategic concentration, really, aiming for complexity and value over just sheer volume.
You got it. It was about building resilience for the long term by focusing on their core strengths and the most valuable client segments.
Okay, so wealth management is the profit engine. What was the second big lever they planned to pull?
That would be really executing their U.S. bank strategy, making the most of the bank charter they had.
Right, using the deposits generated largely from those wealthy clients across the entire firm.
Exactly. It's about optimizing the balance sheet, taking those stable, low-cost deposits and deploying them efficiently as loans. They set a target to grow their U.S. bank assets. This is across both wealth management and institutional securities from about $151 billion at the end of 2014, up towards $180 billion by the end of 2016.
So nearly $30 billion in growth targeted over 2 years. How are they planning to use those extra assets?
Well, it differed slightly by division. In institutional securities, having that strong deposit base let them expand corporate lending. Relationship loans, event-driven financing for their big corporate clients, that's crucial for keeping those top-tier relationships sticky.
Makes sense. And in wealth management?
That's where they saw, frankly, a massive opportunity. Their own client base, despite being wealthy, was actually quite underpenetrated when it came to borrowing from Morgan Stanley.
Really? You'd think those clients would borrow where they invest?
Not necessarily, or at least not to the extent they could have been. Think mortgages, securities-based loans, tailored credit lines. There was huge potential for balanced loan growth right there within their existing client book.
And here's a detail I found fascinating.
Ah.
They stress the efficiency of this lending growth.
Yes. They highlighted that the required infrastructure, the technology platforms, it was already largely in place.
And crucially, no bricks and mortar, no expensive branch network to maintain for this.
Exactly. So the incremental margin, the profit on each new loan, was described as particularly high.
Very efficient growth then.
Very. Plus, they were also developing broader cash management solutions. The idea was to attract even more of their clients' cash deposits that might have been sitting elsewhere.
So capture more deposits, lend them out efficiently at high margins. It's a neat synergy.
It's a very smart use of their integrated model, using the strength in wealth management to power efficient growth across the board.
Okay, so you've got this stable, high-margin wealth management business growing, fueled by efficient lending from the bank. That must have given them the breathing room, the capital flexibility to tackle the really tough part,
Yeah.
the trading businesses, FICC.
Absolutely. Fixed income, currencies, and commodities FICC had been, well, hammered is probably fair, both by structural regulatory changes post-crisis.
Right, like Dodd-Frank Volcker rule.
Exactly. And also just cyclical market shifts. Volumes were down, volatility was different. It needed a fundamental rethink.
So what was the plan? They couldn't just abandon it, could they? It's core to an investment bank.
No, but they had to make it consistently profitable, earning returns above its cost of equity in the new environment. They laid out a pretty clear three-part plan.
Okay, what was step one?
Step one was optimization. Basically, getting out of certain businesses that just didn't make sense anymore. The main example was reducing exposure to physical oil commodities. They'd already sold Transmontane, their oil merchanting business, in 2014 and committed to getting smaller there.
Why? Too capital intensive.
Extremely capital intensive, a big drag on the balance sheet, and the returns were just too volatile, too unpredictable in the new world.
Okay, so optimization through exits, step two.
Centralization. This was about managing resources much more tightly across all the different fixed income businesses.
Breaking down silos?
Precisely. Centralizing the management of expenses, technology spend, capital allocation, balance sheet usage. Everything managed holistically. The goal was to make sure scarce resources flowed only to the highest returning, client-focused parts of FICC, not just hoarded by individual trading desks.
Smart. And the third step, this sounds like the big one for post-crisis banking.
It is. Continued aggressive reduction of risk-weighted assets, RWAs.
RWA is the measure regulators use to gauge risk and set capital requirements. Lower RWAs mean less capital tied up, right?
Exactly. And the scale of reduction was already staggering. They pointed out they'd cut RWAs in FICC, excluding lending, by nearly half.
Half?
Yeah, from around $370 billion back in 2011 down to $188 billion by the end of 2014.
That's a huge shift, and they weren't done.
Nope. The target for the end of 2015 was to get RWAs below $180 billion.
So voluntarily shrinking that part of the balance sheet quite dramatically.
It shows real commitment to the new model. The aim was a FICC business that was leaner, purely client-focused, much more capital efficient, and, crucially, fully aligned with the tough, new regulatory landscape.
Less about chasing huge trading profits, more about providing essential services efficiently.
That's the core idea, a necessary institutional business, but one-sized appropriately for the new reality. Hashtag 5E, capital, shareholder returns, and the regulatory landscape.
Okay, so putting it all together. Growing the stable, high-margin wealth management, making lending super efficient, and shrinking the capital-hungry FICC business. How did this translate into actual value for shareholders?
Well, the firm pointed to a couple of key drivers for shareholder return. First, obviously, the results of the strategy itself, growing the top line in stable areas, managing expenses tightly.
Right, better earnings quality.
Exactly. But second, they also benefited from a helpful market condition, a bit of a tailwind. Bond spreads had contracted significantly.
Meaning it became cheaper for Morgan Stanley to borrow money itself.
Precisely. As a massive issuer of debt, when the premium they have to pay over risk-free rates comes down, their funding costs decrease. That allowed them to refinance older, more expensive debt at much better rates. It's a direct sort of bottom line benefit.
Nice boost to have. And were they returning this value to shareholders?
Oh, yes. They made a point of highlighting their commitment. They'd already doubled the share buyback program and the dividend in 2014. And then, just before this letter, in March 2015, they got Fed approval for another big capital return plan, a $3.1 billion share repurchase authorization, and another dividend increase.
And they felt confident these returns were sustainable.
That was the argument. Because a greater proportion of their earnings was now coming from those more stable, predictable businesses like wealth management, the capital returns were seen as more durable. Their strong capital ratios, their alignment with regulation that was a foundation that allowed them to confidently return capital.
Speaking of regulation, they included a really striking statistic in the letter, didn't they? Something that just puts the whole transformation into perspective.
They did. It's quite memorable. They stated that the sheer quantum of regulatory change imposed on the financial industry in the preceding 5 years.
So 2010 to 2015, roughly.
Right. That period saw more regulatory change than the entire preceding 50 years.
50 years. That's incredible. It just underscores the massive upheaval they were navigating.
It really does. They stressed how incredibly time-consuming and resource-intensive adapting to all that had been. But the message in 2015 was, okay, we've done the hard yards, we've adapted, and now we believe we're well-positioned to succeed in this highly regulated world. Hashtag BSC, the role of culture and core values.
It's easy to get lost in the numbers, the margins, the RWAs, the billions in assets, but the letter also spent time on the softer side, didn't it? Culture, talent, people.
Yes, and they didn't present it as just a footnote. It was framed as integral to the strategy's success. The argument was that even the best strategy relies on people executing it effectively.
Culture is a strategic asset almost.
In a way, yes, especially during such a massive transformation. A strong, cohesive culture, they argued, was vital for keeping everyone focused and ensuring stability.
And they defined this culture through 4 core values. What were they again?
The 4 listed were putting clients first, doing the right thing, leading with exceptional ideas, and giving back.
Pretty standard corporate values on the surface, perhaps. But how do they connect these to actual business practices, like doing the right thing? How does that play out in an investment bank?
Well, they linked it directly to risk management. The letter emphasized that while risk-taking is inherent to their business, the culture must reinforce rigorous risk evaluation. It ensures that the risks taken are, and I think the quote was, sensible, controlled, and sized properly. So, the culture acts as a guardrail against inappropriate risk-taking that could endanger the firm.
Okay, so ethical behavior directly linked to financial stability. Makes sense. And leading with exceptional ideas. That sounds like the engine for the advisory side, investment banking.
Absolutely. That value speaks to maintaining intellectual capital, innovation, thought leadership, which is essential if you want to command premium fees for complex advice. It's sort of the necessary counterweight to the heavy compliance burden. You still need to be sharp and innovative to compete, even while managing all the new rules. Hashtag outro.
So looking back at this 2015 blueprint, what's the big takeaway? It really feels like the end of one era, the post-crisis transformation, and the clear beginning of another.
I think that's right. It marks a pivot to focused execution. The plan was clear: generate consistent returns over the cost of capital.
And the engine for that was going to be this stable, high-margin wealth management business, coupled with much more efficient use of capital, especially in the institutional businesses.
Exactly. A simpler, more resilient, more focused Morgan Stanley, built for the regulatory environment of the time. Reflecting on that point about regulation more change in 5 years than the previous 50, it does raise an interesting question for you, our listener, to think about. When you have such a massive, maybe unprecedented shift towards oversight, compliance, and ensuring stability, how does that intense focus potentially impact a large financial firm's ability to innovate?
The tension between innovation and stability.
Right. Is there a trade-off? How do firms balance the need for rapid adaptation and growth with the absolute necessity of institutional resilience in this highly regulated world? Something to mull over.
That's a great final thought, a real balancing act that defines modern finance. Well, thank you for walking us through the details of this strategic pivot. It's fascinating to see how a giant firm can reshape itself under pressure. We hope this deep dive gives you some valuable context for understanding how major financial institutions strategize and adapt. Thanks for joining us.